Hey, it's Aaron. Do you live in California? Do you think the state income tax is already high enough? Well, in this video, I'm going to show you that there's a bill in the California state legislature sponsored by Gavin Newsom called ACA 11, which is going to propose increasing California's already highest income tax to an even higher level to fund a state-sponsored universal health care program for its citizens. Now, I think the idea of giving more healthcare support for citizens is a noble intention, but my issue is the way California has managed social programs in the past, whether it be unemployment, taking forever to pay out, and then being paid out to a lot of fraudsters, over $20 billion paid out to fraudsters. Billions of dollars raised to solve the homeless problem, and it actually only gets worse. When I lived in California, I only saw the situation get progressively worse until I left in 2020. In this video, I think we're going to look at some key things in the bill that are going to impact you as an employee, but also you as a business owner, because the bill has provisions for both receiving increases in their taxes. So go ahead, smash that like button. Let's get this video out to more people, whether you live in California, you used to live there and you recently left, and you hate to see the state continue its further decline, or you're thinking about moving there. It's important to understand what's going on in the biggest state in the nation that has such a large economy and a large tax base. So go ahead, smash that like button, and let's get started. All right, let's take a look at the article from the Tax Foundation. California considers doubling its taxes. A proposed constitutional amendment, ACA 11, in California would increase taxes by $12,250 per household, roughly doubling the state's already high tax collections, to fund a first-in-the-nation single-payer healthcare system. The top marginal tax rate on wage income would soar to 18.05%. Nationally, the median top marginal rate is 5.3%. And the state would adopt a new 2.3% gross receipts tax at a rate more than 3 times that of the country's highest current peer GRT, gross receipts tax. All told, the new tax package is intended to raise an additional $163 billion per year, which is more than California raised in total tax revenue any prior year to the pandemic. That is crazy. That is staggering. The new taxes would take 3 forms. Surtaxes atop the current individual income tax structure beginning at $149,509 in income, a graduated rate payroll tax system with the top rate kicking in for employees with more than $49,990 in annual income, and a gross receipts tax of 2.3%, excluding the first $2 million of business income. I want to pause here for a second and talk about these surtaxes atop the current individual income tax starting at $149,000. You may say, well, that's, tax the rich more. Sure, but you could very easily, no, not easily, but it's very likely that a lot of people in California make that, but due to the high cost of living in California, 150 grand in California is not 150 grand in other places, especially Southern California or Northern California. And so, that's like probably like a hard job, to have that level of income. It takes a lot out of you. And with the government coming in and taking more of your hard-earned money at that level, it's a tough thing to stomach. It's a tough thing to take. And I think anyone's willing to contribute to their state, contribute to their country, and contribute to society through taxes. But when you see how a state has used your money in the past so flagrantly, so inefficiently, then it feels like, why? I don't want to do this. It's not necessary. So I think that's where the main issue with this bill is. Now, the second part, a graduated rate payroll tax system with the top rate kicking in for employees with more than $50,000 annual income. Well, this is coming for not everybody, but basically everybody. So like no one is exempt from this. And then gross receipts tax of 2.3%, excluding the first $2 million of business income. This means if you have a small business, after $2 million, you're going to pay 2.3% as a new tax of any earnings above $2 million. It's a gross receipts. It's not after tax deductions and expenses. It's just boom right off the top. So, it's just another thing that's making small business hard to have in California. Now, it says 2 states currently have payroll taxes for purposes other than funding their unemployment insurance. Now, in Massachusetts, they actually have a payroll tax of 0.68% imposed atop the state's 5% flat individual income tax. Now, in Nevada, payroll tax of 1.475% in lieu of any individual income tax. It's very low. California would impose a payroll tax of up to 2.25% atop an individual income tax that already has a top marginal rate of 13.3. Now, in a moment here, we're going to get to 13.3. Yes, that's for the people making millions. But as a state increases the taxes for the top, it's going to bring up taxes for everybody. I'm going to show you in a second. Similarly, several states have gross receipts tax in lieu of corporate income tax. In Ohio, for instance, there's a 0.26% gross receipts tax adopted to replace the state's corporate income tax, capital stock tax, and business tangible property tax. In California, by contrast, a 2.3% gross receipts tax, almost 9 times Ohio's rate, would be imposed in addition to tangible property taxes and an 8.84% corporate income tax, and an aggressive one at that, and the only state-level corporate income tax in the country with a worldwide tax base. I believe that means no matter where you have company operations in the world, you have to pay California income tax if you're based in California. So what it's saying here is, yeah, Ohio has a gross receipts tax, 9 times smaller than California's, but they don't have a corporate income tax. And so California has all of these. So businesses are going to be hit even harder with more taxes. So, and while 16 other states implemented or enacted individual or corporate income tax cuts in 2021 and looking to join them in 2022, California policymakers voted to approve 5 new surtaxes with a top rate of 2.5% atop the current 13.3% top marginal income tax and the proposed 2.25% payroll tax for a combined top marginal rate of 18.05%. That's more than 7 percentage points higher than the next highest rates in Hawaii, at 11%, New York, 10.9%, New Jersey, and DC, both at 10.75%. Now, issues with the proposal abound. I would hope so. For instance, the payroll tax exempts employers with fewer than 50 resident employees, punishing small businesses for expanding and creating a meaningful tax cliff. Imagine, for instance, overly simplified hypothetical of a company with 49 employees making $80,000 each. At 49 employees, the bill has no payroll tax burden. Hiring one additional employee creates a tax bill of $90,000 more than that employee's salary in that scenario. So really it's like, hey, you're a small business, you want to do aggressive expansion, things are going well, even during these tough times in the pandemic, suddenly in order to do that expansion, you have to pay through the nose. Like, oh, it's only 2.3%, but then if you cross that threshold, that's such a large hit. And this is the type of stuff, type of legislation you have to watch what the government is doing in California or anywhere else. This is the thing they're trying to do. They want more money and they want more control, things like that really impede a business and a person's ability to build wealth. And that's I think the concerning thing here. So let's jump to the tax tables. So gross tax receipts are widely understood as extremely disruptive and inequitable taxes because they're imposed on businesses without regard to their profit margins. For low profit margin businesses like supermarkets, 2.3% of gross tax receipts may literally exceed current profits even if the company is doing well. For instance, Kroger's profit margins dipped to 0.75% in late 2021 and have historically been around 1.75%. These taxes are even worse for businesses posting losses, including startups that haven't turned profitable yet, because they are taxed on their receipts even if their expenditures exceeded revenues. For startups, a high rate gross receipts tax could be disastrous. Think about it. Well, yeah, sure, it's startups funded by a bunch of VC money, losing all that money trying to grow, and it has to pay an additional 2.3%. But actually even more concerning is that small mom and pop business, that small grocery store in the corner, that's been struggling through the pandemic and the lockdown, all of these things. And now, even if they have a profit, they have slim margins in that kind of business. Maybe it's a janitorial business, whatever, it's family run, now has to pay even more despite what their taxable, their tax adjusted income is. Right off the top, another 2.3% has to go to the government. The surtax, meanwhile, with additional rates of 0.5% to 2.5% atop the current income tax, does not take married filers into account. So while California state income tax avoids a marriage penalty for most filers by doubling bracket widths, this is already an additional 1% above the $1 million, which is not adjusted. The new surtaxes do not. The $149,000 kick-in of the 0.5% applies to the individual or the household income equally. So like single household earners or single, people filing single get actually hit disproportionately more in a sense. Similarly, these surtaxes do not align with current brackets, so they yield a highly convoluted tax system. Add the payroll tax, which is borne economically by taxpayers even if remitted by their employers, and is essentially 18 brackets as follows. Taxpayers earning less than $50,000 would face, inclusive of the new payroll tax, double-digit marginal tax rates. Here's the new sort of estimated tax brackets if this bill were to pass. And here's what I want to talk about specifically. Let's zoom in on the 61 to 149,000. So basically, that is arguably probably the biggest swath of the population in California. And especially if you get up to the 299,000, that 61 to 299, I mean, that's like the biggest population in California. And that's an analogy I like to think of for California taxation-wise and earning. You can do well, get to that low six-figure mark, but if you don't make it past that, it's kind of like being on the beach. You're not on the beach, but you're not all the way out in the water, bobbing up and down. If you're making 50 grand, you're struggling, you're trying to keep your head above water. But if you're rich, making millions, you're on the beach having a good time. But if you're like mid-low six figures, you're right where the waves are crashing, just bam, 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 getting hit by so many taxes, W-2 employee maybe, or a struggling small business, and it's tough to get out of that constant loop of like, it seems like you're earning good, but then so much gets taken away by taxes on top of federal income tax already. And so that's California to me. These taxes, moreover, could be increased by simple majorities in the legislature, as the bill exempts 3 new taxes from the Constitution's supermajority requirements for tax increases. If a future legislature decides that doubling the state's tax collections was insufficient, the Constitution's supermajority requirement would not stand in its way. And while the new surtaxes are inflation indexed, the payroll tax's second bracket is not. So the legislature is authorized to suspend inflation indexing at any time, which would lead to the particularly curious case of inflation indexing the standard income tax bracket, but not the surtax brackets. Inflation indexing is saying, hey, this sort of tax rate cannot increase more than inflation, which we know is probably going up anyway, but still it's kind of like, it's really like a hedge to control for costs, but if they suspend that, it also removes their ceiling, and they can raise it higher to whatever discretionary amount they want. So that's another little issue. So this is not the first time California lawmakers have considered creating a single-payer health system, which previous estimates pegged at requiring $200 billion in additional state funding. This assumes, moreover, that California secures federal approval to redirect approximately $200 billion in federal funding towards a health care match, since the full cost of the program is around $400 billion a year. Even with that match, the numbers only balance if a single-payer system generates significant cost savings, an assumption that is, at minimum, controversial. And as with prior considerations of one-state single-payer proposals, there are questions of whether residents would still need health insurance to cover while outside the state, depending on how the program is designed. The proposal for a $163 billion a year tax increase comes at a time when California is projecting a $31 billion surplus, after tax collections grew at an annual rate of 30%, the fastest in at least 4 decades. The $163 billion in additional revenue that proponents of ACA 11 hope to generate each year exceeds all state revenue any year prior to fiscal year 2020. Like most states, California's revenues grew rapidly over the last 2 years. Unlike most states, however, California faces a downside risk in the form of continued exodus of taxpayers. People are leaving left and right. I got out too. Accelerated by the rise of remote work and increased mobility. California lost 0.8% of its population between April 2020 and July 2021, 4th largest decline in the country after DC, New York, and Illinois. Practically doubling state taxes, even if the burden is partially offset through state-provided health care coverage, could send taxpayers racing for the exits. So I think one of the key things among many of that article is that they're putting provisions in that bill to suspend inherent limits in the bill. They can change the fact that it's no longer going to be inflation indexed and it can increase to whatever they want. Or if they decide that the amount of money they raised, $163 billion, which is more than the state has ever had in a year, and they actually have a surplus this year of $30 billion, then it's changeable. They can say, well, we need to raise even more. And they can come after you from a perspective of adding even more tax on top. I mean, is it going to hit 20%? Things like that is just, it's crazy, and I think it's just too much. So what do you think? Drop a comment below. Let me know your thoughts on if you think this bill should pass, or if you think it shouldn't, or if it does pass, what you're going to do. Are you going to stay in the state? Let me know your thoughts. So go ahead, smash that like button, consider subscribing, and I'll see you next time.